When you think of the greatest investor of all time, one name probably pops into your head: Warren Buffett. But here's the thing: his whole strategy, it's not some crazy complex algorithm or a secret Wall Street formula. So what we're going to do is crack open his blueprint. We're going to look at the simple, incredibly powerful principles he's used for decades to build astonishing wealth.
So that brings us to the big question, right? How does he actually do it? How does he wade through thousands and thousands of companies to find the real winners? And you know what? The answer is probably a lot simpler than you think.
And this right here, this just perfectly sums up the difference in thinking. You've got Wall Street totally obsessed with speed, complexity, and trading in and out a million times a second. And then you have Buffett, just operating from his quiet office out in Omaha, Nebraska. His whole game is the complete opposite. Keep it simple, be incredibly patient, and this is key: think like you own the business, not like you're just gambling on a stock price.
Right, so this all kicks off with what we're calling the Omaha mindset. Because look, before you even think about what to buy, you've got to get your head right. It's all about adopting the right mental framework first. And the absolute foundation of that mindset is this idea he calls the circle of competence. It sounds so simple, but it's really profound. The idea is only, and I mean only, invest in businesses you actually genuinely understand. If you can't sit down and explain how the company makes money and what its future might look like, you just stay away. Doesn't matter how hyped up it is. So here's the really crucial takeaway from that. Your job isn't to know everything about every industry. No way. Your job is to be brutally honest with yourself about what you don't know. Drawing that circle, defining your limits, that's where the real power is. Okay, so you might be thinking, how do I make my circle bigger? Well, you do it the same way Buffett does. You become a learning machine. I mean, the guy famously spends 5 to 6 hours every single day just reading. We're talking annual reports, industry journals, business history, all of it. That knowledge, that's the fuel for every good decision he makes. All right, so you've got the mindset down. Now what? Now it's time to actually go hunting. But listen, you're not just looking for any old company. You are on the hunt for the truly great ones, the ones with a real, lasting advantage. And this is where we get to one of Buffett's most famous ideas, the moat. Think about it like an actual castle. The moat is what protects it from invaders, right? Well, a business moat does the exact same thing. It protects a company from its competitors. So he's looking for companies that have this durable, long-lasting advantage. They've got a history of making money consistently, they can raise their prices without everyone fleeing to a competitor, and, this is a big one, they don't need to pour a ton of cash back into the business every year just to keep the lights on. And this is a huge mental shift you have to make. You got to stop thinking of yourself as a stock trader playing the market. Instead, you need to start thinking like you're a business partner. You're looking for amazing companies to own a piece of for a very, very long time. It's a piece of a real business, not just some blinking symbol on a screen. Okay, so let's say you've done it. You found a wonderful business, it's got a huge moat, and it's right inside your circle of competence. You're not done yet, though. Not even close. Finding a great company is only half the battle. Now comes the really critical part: figuring out what's a fair price to pay for it. The way Buffett tackles this is by figuring out something he calls intrinsic value. And for this, you have to completely ignore the daily stock price. Just forget it exists for a minute. Intrinsic value is all about what the business itself is actually worth deep down. Here's a way to think about it. If you bought the entire company, all of it, the intrinsic value is all the cash you could pull out of that business for the rest of its life. That's its true fundamental value. And this is where the real magic happens. The goal is so simple, yet so powerful. You want to buy that wonderful business for way less than what you've calculated it's actually worth. That gap, that discount, that's what he calls the margin of safety. It's your cushion. It's what protects you if you messed up your math or if just plain old bad luck hits. So, how does he even begin to figure out if a company is healthy? He digs into the numbers, and there are a few key metrics he always looks at. First up, return on equity. He wants to see that it's consistently high, because that shows the people in charge are really good at using investors' money to make more money. Next, debt. He wants that to be low, super low. Why? Because it means the company is safe. It's not one bad quarter away from disaster. Then you've got profit margins. They need to be strong and stable. That's a huge signal that the company has pricing power. And finally, maybe the most important one of all, free cash flow. Is it robust? Is it growing? This is the actual cash that's left over for the owners, like you, at the end of the day.
But here's the thing. You could do all that analysis perfectly, and it would all be completely useless without this final piece of the puzzle. And honestly, it might be the most important piece of the whole blueprint. We're talking about the patience principle. You know, Buffett has said over and over again that you don't need to be a rocket scientist to be a great investor. What you do need is the right temperament. I'm sure you've heard this one. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, when he says that, he doesn't mean a stock you own can never go down. That's impossible. What he's talking about is avoiding those massive, catastrophic mistakes that wipe you out for good. It's a rule that's all about discipline, controlling your emotions, and always, always making sure you have that margin of safety to protect you.
And this really frames it perfectly. Think about it. The stock market is basically designed to make you emotional. It's constantly screaming at you to do something. Buy when everyone's euphoric, sell when everyone's panicking. But real long-term success comes from tuning all that noise out. It's about having the strength to resist those urges, buying those great businesses when they're on sale, and then just being patient, letting the value grow over years and even decades.
Okay, so we've talked about the mindset, the hunt for great businesses, paying the right price, and the patience to hold on. But what does it all really boil down to? Let's tie this all together for what is maybe the ultimate takeaway from this entire blueprint.
Because when you really look at it, all of these ideas, learning, being disciplined, being patient, they're all pointing to one central truth. And it's this: by far, the greatest investment you will ever make is in yourself. The more you learn, the bigger your circle of competence gets. And the bigger that circle gets, the better your decisions become. And I'm not just talking about investing. I'm talking about in everything. And that really brings us to the final question I want to leave you with today. Because remember, this whole thing isn't just a stock-picking strategy. It's a way of thinking. So take a second and really think about it. What's inside your circle of competence? Maybe it's your job or a hobby you're obsessed with, something you're truly passionate about. Whatever it is, that's your starting point. That's your blueprint.